Good morning, everyone, and happy summer. Welcome back for another edition of my weekly newsletter. We're almost halfway through 2024. It's officially summer, and it's the last week of quarter two. We've had an up and down year. We went into the year very optimistic about the real estate market as a whole. We thought interest rates would start falling. We thought the market would pick back up, inventory, you name it. And we've seen kind of the exact opposite play out. We saw interest rates hit as high as 7.52% in April for an average, and as low as 6.33% back in early February. So we've seen a lot of up and downs. Rates have been bouncing back and forth between a range of around 1.5% from top to bottom. But the good news is I think we could finally see the shore on the horizon. And it's going to take a matter of finishing up the summer and heading into the election season before we really get some clear context and a materialistic idea of where rates will end up for the remainder of the year. So taking a look at this week, we did end last week on another positive note. Interest rates have continued trending down for the third straight week. The average mortgage rate ending the week of June 20 sat around 6.87% as per Freddie Mac. So this is great news. We're under that 7% threshold on average across the nation. And I am going to pull up a chart here that's going to show you what's transpired in the past 2 weeks and where we saw that big drop off in rates. Flipping to this chart of the 30-year fixed rate mortgage, we can look at the month of June, and we're going to just kind of retrace where we were. And at the beginning of the month, we did see a slight uptick, bounce back from some recent lows that we had seen. And then in the middle of June, just a couple of weeks ago, we did get that positive CPI and PPI inflation data, and that did cause a sudden drop off in rates to below 7%. Since then, we have seen rates kind of moderate. They've leveled out around that 7% threshold, going a little above and a little below. The reason I want to show this to you is because it does show two trend lines. One is Mortgage News Daily's rate quotes, and one is Freddie Mac's. So with these surveys, I've mentioned this before in the newsletter, they are reported in increments or weekly increments, and the data is typically lagging. So this is why you'll see this overall trend line falling, albeit a little bit lower than what Mortgage News Daily is forecasting as the going rate. The other factor that isn't considered in this average from Freddie Mac is that this does not include buy downs, people that have paid points to obtain a lower interest rate than normally quoted at. So that's why this is below the actual market average. So even though Freddie Mac is reporting below 7%, rates are over that threshold as of the time of this recording, the beginning of this week. So just keep that in mind. The survey from Freddie Mac is a great indicator of overall interest rate market and the direction that it's heading. So we'll continue to follow both, but I did just want to point out that these are different. And the reason is that Mortgage News Daily is providing these quotes on a daily basis based on the going average rates being offered by investors, banks, and lenders. And the Freddie Mac is based off of a survey based on closings and locks. Looking at last week, we really didn't have much market moving data or notable events. We even had the market closed on Wednesday for the Juneteenth holiday. The most notable in terms of data would be retail sales, which came in lower than expected. This is good news for interest rates and the overall outlook from the Federal Reserve. The idea being is that if U.S. consumers are being a little more frugal or pulling back on their spending, this does mean that the Fed's objective towards tightening the economy is working. If they're pulling back on spending and now pinching pennies, that means either the job market or the overall cost of goods and services is starting to have its impact and play its course through the economy. So this is something that was good for rates. It didn't necessarily move markets, as you can see in that chart that we just went over. Rates have leveled off in the past week, but now looking to this week, we do have a little more notable data on tap, especially on Friday. We have the personal core expenditure reading, which is PCE. And as I mentioned in last week's newsletter, this is the preferred inflation measure of the Federal Reserve. CPI and PPI were the readings or the data points that really started this movement in rates lower. That was where we saw that really stagnant drop off of over 0.1% in just one day. But this PCE reading is really what the Fed's paying attention to when they talk about that overall 2% target. So looking at the next chart, I did touch on this last week. We're going to just take a quick look at where that inflation level has come in recent months and where it's expected to be this month. If that continues to trend in our favor, this momentum towards lower rates could continue. And even though we're hanging around 7% right now, it's really a matter of getting under 7% and staying there. Last time we got under 7%, we hit as low as around 6.53%, and we bounced right back up to new short-term highs for 2024. So this is going to be a huge factor that's going to come into play in the short term for rates. So be on the watch for Friday. And if we do have any crazy developments, as always, I will be coming out with an emergency newsletter number 4. So taking a quick look at this PCE chart, this is again a trend line for the overall inflation measure that the Federal Reserve is monitoring and hoping to achieve that 2% target. So we'll see where history really brought us over that percent or that range. That was related to the COVID pandemic. And ever since, and especially over the course of the past year, we have been on a subtle and gradual trend towards that 2% goal. We have not seen any reversals, no trends higher, which is all reassuring and great news. Looking at expectations for this month, economists are expecting core PCE to rise 0.1% month over month and 2.6% year over year. So right now, we are still above the mid 2% threshold. As we get the reading for this month, we're hoping to move a little lower, make some progress towards that 2% goal. And if the reading does come in line with expectations, I do expect momentum to continue lower. If it does come in lower than expectations, this is where you might see interest rates drop another 0.1% or more in just a day or so. And if they come in higher, all bets are off. We could see an immediate reversal in the recent trend towards lower rates, and we could see rates back in that 7.125, 7.25% threshold. So this is definitely going to be a notable Friday for everyone. So keep your eyes and ears open. I'm sure the media and news outlets will be publicizing all of this in the days to follow. Looking at the interest rate market this week, rates are sitting at similar levels to last week. For conventional loans, we are sitting in the high 6% to low 7% threshold, sitting between 6.875 to 7.125%. For FHA and VA loans, we're sitting in the mid 6% range, between 6.375% and 6.625%. And we are still in the midst of an extremely volatile interest rate market. This means that the interest rate offerings and the points associated with those offerings are changing on a daily basis. So as a buyer, you do need to stay up to date with your loan officer, make sure your pre-approval amount is not changing. And as a realtor, make sure your buyers are always staying in touch and keeping on top of their finances, because if there are any sudden changes, this could be the difference between a deal falling apart after contract signing or not. For industry news this week, we're going to take a step back and look at the overall housing market. With summer officially underway, Q2 wrapping up, a lot of people have been revising forecasts and revising their predictions for the remainder of the year, especially for the housing market and the interest rate market. Fannie Mae did trim their forecast for home sales and origination volume. This is based on the fact that interest rates have remained heightened throughout the year. They revised their 2024 home sale forecast down to 4.82 million, a modest 1.3 annual gain from the previously expected 2.8%. So they revised their forecast. They almost cut it in half for the remainder of the year. This is, again, based on inventory issues and the surge in interest rates and the affordability crisis. The good news is home prices did hit a record high in May. The national median existing home price in May was $419,300. This was up 5.8% from a year ago. So anybody that's been saying that real estate as a whole has not been appreciating or going up in value, it obviously comes down to the market you're in. But overall, real estate values and home prices has continued trending higher. This is a trend or a theme that's continued since the pandemic. And lastly, housing starts have fallen to a 4-year low. So new construction activity, builders are really pulling back on the amount of homes they're building. This is in part to the high cost of materials. And then also the affordability issue on the sell side. They can't necessarily find buyers for all of the properties they're creating. So home builder confidence has dropped rather remarkably as of recent, and this is also spurring to forecasts or for housing start forecasts to fall as well. That'll do it for me this week. Again, pay attention for Friday. This will be a huge day for interest rates in the short term. Otherwise, I will see everybody next week. Enjoy your week.